Professor AC, I watched the financial news yesterday and heard that the Federal Reserve announced it would start reducing its balance sheet. Do you know what that means?
Yes, of course. It is known as balance sheet reduction, which refers to the central bank reducing its assets, thus shrinking the size of its balance sheet. This is typically achieved by reducing the purchase of financial assets such as government bonds and mortgage-backed securities, or directly selling these assets.
Oh, I see. So, what is the purpose of balance sheet reduction?
The main purpose of balance sheet reduction is to tighten monetary policy and reduce monetary liquidity in the market to address inflation or an overheating economy. Simply put, by selling the assets held by the central bank, the capital flow in the market is withdrawn and reduced, thus decreasing the amount of money available in the economy.
When does the central bank usually start reducing the balance sheet? Can we predict when the central bank will do this?
We usually can know exactly when the central bank will start reducing the balance sheet. However, generally speaking, after implementing quantitative easing or other unconventional easing policies. If the economy shows robust growth or experiences overheating and inflation, the central bank will perform balance sheet reduction to return to normal monetary policy or to prevent economic overheating and asset bubbles.
So, Professor AC, will balance sheet reduction impact the financial markets?
It certainly will, especially when the Federal Reserve reduces its balance sheet, which has a significant impact on the financial markets. Reducing the balance sheets means that market liquidity decreases, usually accompanied by increasing of short-term and long-term interest rates. At this time, bond prices typically fall, especially since the assets sold by the central bank often include bonds, increasing the supply in the market and putting pressure on bond prices. On the other hand, it also represents decreased market liquidity and expectations of rising interest rates. In this case, the currency usually strengthens. This is because higher interest rates attract investors to hold the currency, and reduced liquidity means a decrease in currency supply, thereby pushing the currency stronger.
What about the stock market?
It also has an impact on stock market. Reducing the balance sheet decreases market liquidity and raises interest rates, increasing borrowing costs and reducing liquidity. This leads to fewer funds flowing into the stock market, and higher borrowing costs reduce the investment capacity of businesses and the consumption ability of consumers, directly affecting corporate profitability and stock market performance. Overall, reducing the balance sheet is generally bearish for the stock market.
Oh, I see. Thank you, Professor AC.